Right, it's time to look at our first pillar in depth. Mr. Paulson, you'll have seen the agenda today, and you'll have seen that we're handing over quite a big proportion of the day to pillar number one, which is investment. And Mark, I know, like all throughout the months and months of planning that have gone into today, there's been something you've been banging the drum about.
Right. So this is where a lot of this conference started. Last year, right, when we had Trustonomics. And the country set its hair on fire and started running around the car park wondering why its head was hot. Portfolios started doing weird things, right? And we were routinely seeing people's portfolios at the lower risk end being more volatile than at the higher risk end. And it struck me that this is one of the two hard things, right? People were just kind of hoping that stuff was going to return to normal, and that was fine. But what if they don't? And the answer isn't, well, we just changed portfolios, Mark. The answer is that the fundamental building blocks of how we ensure suitability for clients and how we build risk profiling tools, how we build cash flow modeling tools, all the stochastic modeling the industry does, all the rest of it, all of that depends on a set of assumptions being true. And what if they're not true anymore? And it all kind of boils down, Steve, to the fact that what if bonds are no longer negatively correlated with equities, right? What if you can't control volatility in your risk-free portfolio by increasing your bond exposure? Because what?
Wait. Like, I'm sure most people in the room are following this, but we know from our data that not everybody defines themselves as an investment expert, and you're going straight into jargon. Going straight into jargon.
But so we need to. The sting at the start that complexity is not a vice, Steve.
You need to unpack it in layman's terms. Let's start like negative correlation. Not everybody knows what that means.
Oh, come on. There are some blank faces, actually. All right, look, it's not hard. A negative or an inverse correlation, people, between two variables indicates that one variable increases while the other decreases. That's all. And vice versa. This relationship may or may not represent causation, because causation and correlation, as you all know, are not the same thing, ladies and gentlemen, are they? But it does describe an observable pattern. Now, key takeaways from thinking about negative correlation, of which I'd say there are 5, are these. The first would be that negative correlation, of course, does occur between two factors or variables when they consistently move in opposite directions to the other. But the second is that investors can utilize assets showing what?
Stop.
What?
You're reading that out.
I'm not.
You don't know this. I've just looked it up on Investopedia. You're reading it directly from Investopedia.
I'm not. In negative correlation to reduce the level of risk in their portfolios without harming returns.
I've got it here. Look.
I'm ignoring you. Even though two variables may have a strong negative correlation, this does not necessarily imply that... All right, yeah. All right, yeah, I'm rumbled.
Rumbled.
I am reading it. Here's a problem, right? I mean, I did get standard grade maths. That was like GCSE or something for you lot. And I didn't really go a lot further than that. I think we've probably topped out. What are we going to do?
I'm not an investment expert. I don't know what I'm talking about.
No, and there's none in here. I mean, we need one.
We need one.
But where are we going to find investment expert at this point in time? I don't know. Like what you'd choose, right? If you're putting the data together, and I could have got away with reading that stuff out. You've got to be all like, you're reading it out and calling it and stuff. I could have got away with it because I've got the skills with the public speaking and stuff, which, you know, you keep working. What you'd probably want is a chief economist from like one of the world's biggest asset managers, right?
Who would that be?
I can't think.
That'd be like Schroders?
Not Keith Wade. Ladies and gentlemen, please welcome Keith Wade from Schroders. Keith, thank you very much for doing this and for indulging our total nonsense. Keith really does know what he's talking about, and he's here to help us launch Pillar 1 in investment, having had our summary so far. Keith, I've got this bee in my bonnet about how portfolios are behaving and what happened last year, as you heard. But before we dive in a little bit more of that, and Keith can spend, 10-15 minutes with us just going through a few bits and bobs. Tell us, first of all, what you're seeing out there. Tell us a quick economic update from you.
Okay, thank you. Thanks for that introduction. I've never had an introduction quite like that before.
Good.
I have to say. So I think maybe the place to start actually might be about a year ago when everybody was saying that, we had a bit of an inflation problem, but it wasn't a big problem. And if you may remember, the word at the time was transitory. Everybody said, oh, inflation's gone up, but it's only transitory, it's only because commodity prices have gone up and so on. And I think to really understand what happened to markets last year, you have to go back to that point and then look at what happened, because clearly inflation was a much bigger problem than anybody expected. And again, if you go back a year and you ask economists, including myself, I'm ashamed to say, where will interest rates go by this time, a year's time, I would have said, oh, they could have gone up to about 2% or something like that. And clearly, we underestimated the size of inflation, we underestimated how much interest rates had to go up, and that's why bond markets performed so badly last year. But it was also an unusual year because the reason interest rates were going up was, of course, inflation. And we hadn't had an inflation problem for ages. I mean, I was tempted to say decades. I mean, it's going back to when I first started in this business, it was sort of 80s and 90s. So it was kind of a bit of nostalgia, but it was certainly very different. And it meant that interest rates going up at a time when we had an inflation problem, that meant that growth wasn't going to be so good. So risk assets fell in value. So you had that very unusual combination where you had, both things falling. So instead of the negative correlation, you had the positive correlation. And that to me is really what happened. And that's why we had that terrible year for what we used to call balanced portfolios. In fact, I was looking at a chart only earlier this week which showed that the 60-40 portfolio had its worst year since 1926, which is quite extraordinary.
So when people are putting these portfolios together, it's not just about outcome, right? There's different sorts of outcome. There's the outcome at the end, how much money have you got at your retirement age or the age you want to draw from your investments and all that stuff. But there's also journey style outcome. What are you experiencing along the way? And if that wasn't true, then we wouldn't have different risk level portfolios because we'd all have it time linked and do different things. So on the basis that a bunch of investors who wouldn't have expected their investments to perform in the manner that they did last year did experience that, should we be attacking the thinking that's gone into building these portfolios over time? Should we be re-examining the correlations that exist? Fundamentally, is this sector, which systemizes investment to a huge degree, have we got some underlying fault lines that we need to worry about?
Yeah, I think we probably have. I mean, of course, now, bond yields are much higher, so people have kind of caught up with the situation and people recognize the inflation problem. And the central banks have obviously increased interest rates quite a lot now. So, in some ways, we've adjusted, and there's a little bit of a sign that bonds and equities are starting to behave a little bit like they did before, but not quite as much. So I think we have to think pretty hard about, what other assets are out there and how we might be able to get what we in the industry call hedges against our risk, think of other ways of trying to find that. Because, bonds could do it for a little bit, but I actually believe that inflation is probably going to be with us for some time. It will probably come down a bit over the course of this year. But going forward, a lot of the things that kept inflation down will probably reverse. For example, we're seeing a lot of negative news about China at the moment. China's been a huge force in keeping inflation down over the last couple of decades. If we don't trade as much with China, we'll probably have more inflation. So those kind of things make me think that inflation could be more of a problem than it had been over the last decade. And if you think that, then you've got to start thinking a bit outside the box in terms of what assets you might choose.
So what does that mean in practice? Where can you go? I mean, for Advisor firms, of course, many of them, and we'll talk about this more in a little bit, but they outsource their investment propositions to fine companies, including your own, and obviously lesser ones too, but we don't talk about them. But there's a lot of money washing around this sector, and there's a lot of people in these portfolios. So where do they go? Because it's got to be readily available, daily tradable. These have got to be mainstream assets for retail investors.
Yeah, so I mean that's the challenge, and I mean people are still trying to find their way. But things that have worked quite well in this kind of environment are things like commodities. Either a sort of direct investment in commodities or in, some funds. You can look at energy funds or some mining funds or what have quite a good correlation with the underlying price of the oil price or the copper price or what have you. So certainly I think the whole commodity space is one that people need to look at, and it's not always easy to get the vehicle that you need to be able to invest in that directly, but certainly we have been looking at investing in sector funds and things like that to say, well, actually that would correlate quite well if inflation picked up. But there are other things as well. In many ways it goes back to a world where cash can actually work quite well, because if you get more of an inflation problem than you expected, then the Central Bank of England has to raise rates by more. So you can get some benefit from that. The other one that we've used quite a lot at Schroders in our multi-asset area is just holding dollars or being invested in US dollar assets, because one of the features of the markets is that when things go wrong and you've got a lot of bad news or what have you, the dollar tends to perform well. It's a safe haven. So that was something that we did see last year, and we're still seeing a little bit of it now, the dollar being strong. So I've just actually come from an asset allocation meeting where we had a big debate about, do we want to hold bonds again, or should we just try and stay long in dollars? The conclusion was to stay long in dollars. Because if things go wrong, the dollar tends to strengthen. So that's something I think investors need to look at.
That's really interesting. It actually leads perfectly into the next thing I want to ask you, which is routinely those that provide financial planning to their clients and are more hands-off on investments will be saying, listen, you just set it and forget it. Just don't worry. Everything is temporary. Things will revert to the mean. If there's been problems this year or the next couple of years, don't even worry about it. It will go back. And what we're used to, with the correlations we're used to and the performance signatures we're used to, they'll all come back. It's just not something to worry about. You concentrate on cooking fish or whatever it was you were doing, right? What do you think? Did something bigger change with global kind of dynamics changing with China and the States and Russia? And is there something big that's changing that would make people who say, no, I've got modelling that goes back to the First World War or whenever it was, and it says it always goes back to what I expect, so I'm not going to worry. What's your view on that kind of, I guess, dogmatic or phlegmatic kind of response?
Yeah, I mean, I think it will partly depend on your time horizon, because things do tend to mean revert, but they can take a long time to do so. And I'm talking about 10 years, and a lot of clients would probably be saying, well, hang on a minute, this is getting a bit hairy, and we haven't seen the mean reversion yet. And a lot of the models, are based on the experience of the last decade or so. And I think that was a very unusual decade. We came out of the global financial crisis. We saw interest rates pretty close to zero for almost 10 years. I mean, that's extraordinary. And when I look at these long-run charts, you can see that that decade really did stand out as something that was unusual. So models that are very heavily based on that period, I think, have got to be really careful. And I think you've got to have something that looks at, like, well, what happened in the 70s and the 80s, where you had more volatile inflation and you had more geopolitical risk, as we call it, where, the world economy became more fragmented. I mentioned about China. US and China are at loggerheads with each other. Europe is sort of somewhere in between. But it's quite possible that we do see more fragmentation and the world economy breaks up somewhat. And that means that the correlations between, say, the Chinese market and the US market might be different. And that could be something that as investors you could take advantage of. You might get a hedge there or something like that. So I think you have to think about it in those terms. I think the other thing as well is that the pandemic changed quite a lot of things in terms of the way people think. We saw the return of big government. We now immediately turn to the government when there's a problem. It's like, well, government must do something about this and sort it out. It's quite different. And actually both Labour and Conservative are very much on the page with this. We've got to sort out the NHS. We've got to provide more weapons to Ukraine and so on. All these things. It seems to me that fiscal policy is coming back in quite a big way. And previously it was sort of shoved to the side. Now it's like active fiscal policy to sort out problems. And that again will create lots of opportunities and things, particularly in things like renewable energy or what have you. So I do think there are differences, and I think advisors have to be much more focused on where those changes will be.
That's really super. I've got a comment in from somebody called Jim, if that's your real name, Jim. And talk about what other assets are out there agreeing with what you say, so that must feel good that Jim's agreeing with you, Keith. Thanks, Jim, for that economics lesson there. But where are they, and are they investable with capacity and permissible for advisors? And I guess that's the issue here. I guess my closing question to you, Keith, is we're here to think about home truths, and one of the home truths here, I think, is that nobody really wants this to be a problem. Nobody really wants the building blocks, whether it's 60-40 life strat or the set of model portfolios we've designed ourselves if we're an advisor firm or bought in from a discretionary. Nobody really wants there to be a problem and to have to do that fundamental work. Do you think that if we've got time available in the next year and a half, is that work worthwhile? Or would your sense be that actually the answers will probably end up being the same?
No, I think the work is definitely worthwhile. And I think, because you're going to have to be exploring the universe of assets that are available. And also, I think if it demonstrates that, there is a need for all investors to be able to have this portfolio that they had before, which had very low volatility, giving nice returns, they will realise that they won't be able to get that so easily, so they have to work a bit harder to get it. And a lot of other houses will be looking at this problem, because clearly, if you are a manufacturer like ourselves, if you can produce a product that can build those kind of hedges in, then clearly that would be attractive. So, there's a big incentive, I think, to actually investigate it and research it further. I don't think we're going to just go back to the kind of world that we were in before.
Brilliant. Listen, thank you, Keith, for plugging the holes that we undoubtedly were leaving. That was awesome. Thank you very much, Keith.
Thank you.